We are seeing inflation in many places, but it's certainly not uniform, right? So it's not like, basically if demand increases so much in the United States that basically we soak up a lot of, say semiconductor demand, you're going to get inflation for those same things in other countries as well, because it's a global market. And so overall, what we're seeing is that there's, so far inflation has been pretty hot in the United States, more so than say Japan. And it's in large part because, we did more stimulus, meaning that our broad money supply, our M2, grew a lot faster than Japan's and many other countries. And so we in some ways had a larger mismatch between supply and demand than many of those other countries. But like I said, that gets kind of mitigated by the fact that some markets are global, and therefore when it comes to commodities or comes to semiconductors, many places are experiencing inflation, and many places also did stimulus, just not as large of a percentage. So we are seeing a big difference in inflation. It's partially tied to how much stimulus they did. Emerging markets are always, kind of a different matter because they can also experience inflation just because their currency is weaker, not necessarily because they did fiscal stimulus. And so they've actually taken more action to, say, tighten their monetary policy, actually raise rates, whereas developed markets have just, they've gotten less dovish in some ways, but they've not really been hawkish at all.
Mm-hmm. So in your latest investment letter, you make the case that value stocks have started to make a resurgence. So why do we typically see a shift from growth to value when we get a recession and a fundamental shift in fiscal and monetary policy?
So generally, if you look at the long-term history of growth and value has outperformed more often than growth. But there were two really big exceptions, and those were the 1930s and the 2010s. So those are periods of very, very slow growth. And so people poured into, the smaller number of companies that were actually still growing in that difficult environment. They were just secular growers. They basically new technologies or new things that just were growing despite a weak economic environment. So in the 2010s, that was like the FANG stocks, for example. And so those 2 decades were characterized by extraordinarily strong growth performance over value. And then if you look also, generally this growth to value kind of, shift tends to happen around recessions with big changes in monetary policy. And it doesn't necessarily mean that value begins outperforming growth. It could be the opposite. It really depends on what's happening in that environment. So going into the savings and loans crisis of the late 80s and early 90s, value was outperforming into that period. And then that kind of marked the turning point. Because obviously a lot of the issues that places they ran into issues were value oriented, like the financial sector. And then during the 90s, you had this huge, obviously, growth bubble going into .com, and that peaked in 2000, 2001, rolled over, and then you got this long stretch. You had a minor recession. Then you had this long stretch of value outperformance going into the subprime mortgage crisis. Then you had that big reversal, that big change of policy. A lot of the banks blew up. A lot of that was, oil companies ran into issues like commodity companies, all these kind of more value-oriented areas. And instead, those growth stocks, those FANG stocks, did very, very well. And so generally, we see that the market that we're in kind of extends until we kind of say squeeze all the juice out of that orange, right? So the valuations of that factor become very, very high, right? So going into the subprime mortgage crisis, bank valuations were very high. Going into the .com bubble and going into this period now, growth stock valuations are very high. So one is you basically get all the money you can out of them in terms of valuation, and then they basically there's tons of malinvestment at some point in that space. And when you have recession and you have changing fiscal monetary policy, that generally starts to reverse. And some of those things that were kind of left for dead that are actually pretty cheap start to become more attractive. And some of those things that have basically driven this whole latest credit cycle and that are very expensive generally start to underperform. And so my, kind of observation is that we're seeing initial signs of that for growth to value. Nothing fully confirmed yet, but basically we've kind of hit a high watermark where, growth stopped outperforming value, and it's kind of been going in this like sideways consolidation. And it'll be interesting to see if we break up and growth just keeps outperforming, or if that, in some ways did mark a kind of a change in factor performance. Obviously we're seeing the energy shortages and some of these other commodity shortages, things like that are generally pretty good for value-oriented sectors.
So what does the value sector need to continue to keep appreciating versus the growth sector?
Generally higher nominal growth So that can include that significant inflationary component. Another thing that generally benefits value over growth would be, a consistently positive yield curve and potentially higher long-term rates. Because obviously banks, they directly benefit from that, but also growth stock valuations, as high as they are somewhat more sensitive to long duration treasury yields because they represent an opportunity cost, right? So tech stocks can be thought of as very, very long duration assets, arguably the longest duration asset around. You're betting on something basically taking off over the next 20, 30 years. And so when the cost of money is, say, 5%, you're willing to pay less money for that long runway of growth. Whereas when the cost of money is 0%, 1%, 2%, you're willing to pay up tremendously for that growth stock because your opportunity cost is so low. So generally in a rising yield environment, you'd often want to be more value inclined, and in a lower yield environment, generally signaling less growth and cheaper kind of perpetual cost of money, those growth stocks generally do surprisingly well. And obviously that will depend on the company by company specific, but those are some of the trends. Basically, the 2010s was characterized by low yields and slow growth, and commodity abundance, which helped push inflation down, for most of that decade. And so that was a perfect environment for that growth outperformance. But if you do start to see, rising commodity prices, that obviously benefits some value stocks directly. But then if that translates into inflation and then potentially in the longer end, somewhat stickier, higher yields than we saw in the say the 2010s, or at least they stop going down, right? So they just start going sideways for a while. So growth stocks generally maybe get less, they stop getting more expensive and they just kind of stay at whatever valuations they are. That can kind of rotate some of that growth to value perception.
Mm-hmm. So when we think about the cost of money, and we're looking at going into the end of the year here, what do you think the chances are that Powell stays chair of the Fed, and what are the, let's say, the downstream effects if we get a chair that is even more dovish?
So there are people politically tied in more than me that probably can give you better odds of who's to be the Fed chair in a few months. So I'm watching that, but I don't really have a strong prediction on that, I guess is how I'd phrase that. Now, depending on who, what the overall makeup of the Fed is. So it's not just the Fed chair. It's the overall kind of makeup of the committee that chooses monetary policy.